All right, let's talk about the economy. Specifically, we're going to get behind the wheel to understand the two powerful forces that are constantly trying to steer it: monetary and fiscal policy. So here's the situation we're all feeling, right? Prices are going up, which means everything is getting more expensive. But if we slam the brakes too hard to fight that inflation, we risk grinding the entire economy to a halt. It really feels like being stuck between a rock and a hard place. So who's actually in the driver's seat here, and what can they even do about it?
To get a handle on all this, we first need a simple way to think about what the economy even is. So let's imagine it as a car on a very long road trip. And, as we're going to see, it can be a really bumpy ride.
And the goal of this whole trip? It's pretty simple, really. Just travel at a steady, sustainable speed. Not going too fast, definitely not going too slow. But just like any road trip, you know there are going to be some rough patches up ahead.
You see, there are two big problems you can run into. On one side, the car can start overheating. The engine's running way too hot. That's inflation. The economy's just moving too fast, prices are rising everywhere, and your money just doesn't buy as much as it used to. Then on the other side, the car can stall. The engine loses power. And that's a recession. Economic growth slows right down, and people start losing their jobs. So the real challenge is keeping this car running smoothly, avoiding both of those ditches.
So, how do they do it? How do they keep the car on the road? Well, it turns out there are kind of two people in the front seat, each with their own set of controls. The first one operates a really crucial lever we call monetary policy. Okay, I know that sounds super technical, but the basic idea is actually pretty straightforward. A country's central bank, think the Federal Reserve in the US or the European Central Bank, basically controls the spigot for money and credit in the economy. Their whole job is to keep prices stable and make sure people have jobs. If we go back to our car analogy, the central bank has its foot on the gas and the brake. If the economy is stalling out, they can hit the gas to get things moving again. And if it's overheating, they can gently tap the brakes to cool things down. So what exactly are those pedals? Well, their main tool is the official policy rate. This is the big one. It basically sets the foundation for every other interest rate in the economy. They also use something called open market operations, which is just a fancy way of saying they buy and sell government bonds to tweak the money supply. And finally, they can adjust reserve requirements, telling banks exactly how much cash they need to keep locked in the vault. But how does pressing that brake pedal actually slow the car down? Well, there's a ripple effect, and it's called the transmission mechanism. When the central bank raises its policy rate, it suddenly becomes more expensive for your local bank to borrow money. And guess what? They pass that cost on to you and me. That means higher interest rates on mortgages, car loans, and credit cards. It makes us think twice about spending, which cools down that overheating economy. And of course, the reverse is true. Cutting rates is like hitting the gas. It makes borrowing cheaper and gets people spending again. But remember, the central bank isn't the only one in the driver's seat. The government also has its hands on the controls, and their main lever is called fiscal policy. And fiscal policy? That's the government's turf. It's all about two things: how they decide to spend money and how they decide to collect money, mostly through taxes. And believe me, those decisions have a huge, direct impact on where the economy is headed. Back to our car. If monetary policy is the gas and the brake, then you can think of fiscal policy as the steering wheel and the fuel system. The government gets to decide where to point the car and how much gas to put in the tank. So, fiscal policy has two main parts. On one side, you've got government spending. Building roads, funding the military, or social programs. This is like injecting fuel directly into the economic engine. On the other side, you have taxation. Think of taxes as adjusting the weight the car is carrying. Raising taxes on things like income or sales takes money out of our pockets, which reduces our spending power and slows the whole thing down. Cutting taxes does the exact opposite. It lightens the load and encourages everyone to spend more. Now, here's something really interesting. Government spending has this surprisingly powerful ripple effect. It's a concept known as the fiscal multiplier, and it's the reason why a single dollar the government spends can actually be worth much more than a dollar to the economy. Here's how it works. When the government spends a dollar, let's say to build a new bridge, that money doesn't just disappear. It gets paid as a wage to a construction worker. That worker then takes their paycheck and spends it at a local grocery store. The store owner then uses that money to pay their employees, who then go spend it somewhere else, and you get the picture. That initial dollar just keeps moving, rippling through the economy, and creating more than a dollar's worth of economic activity in the end. It's pretty powerful stuff. Okay, and this is where it gets really fascinating. We've got two drivers, right? We've got the central bank on the gas and brake, and we've got the government with his hands on the steering wheel and the fuel tank. So what happens when they're both trying to drive the car at the same time?
I mean, this is the central question of modern economics. Can they work together? Can they coordinate? Or are they just going to end up fighting over the controls, sending the car swerving all over the road? Let's walk through how this plays out. When the economy is in a recession, you want both drivers pushing in the same direction. The central bank hits the gas by cutting interest rates, and the government pumps in more fuel through spending or tax cuts. They're both expansionary, they're working together. Same thing for fighting inflation, just in reverse. The central bank hits the brakes with higher rates, and the government reduces the fuel by cutting spending or raising taxes. Again, they're working together. But the really tricky part is that last one, mixed signals. This is when the central bank is slamming on the brakes to fight inflation, but at the same time, the government is still pumping in fuel with high spending. They are literally working at odds with each other, and the result can be confusing, unpredictable, and frankly, pretty damaging.
Okay, I get it. This all might seem really high level, maybe a little abstract. But this push and pull, this constant dance between these two forces, has a direct and very real impact on your life, your wallet, your everything.
I mean, think about it. The decisions the central bank makes, that directly affects the interest rate you'll pay on your mortgage or your next car loan. The combination of both of these policies, that influences whether companies are hiring or laying people off, which could impact your job. The government's fiscal policy quite literally determines how much you pay in taxes. And maybe most importantly, their combined ability to control inflation determines if the savings you've worked so hard for will be worth more or less in the future. This quote just says it all, doesn't it? It's not about one lever being better than the other. The real art is finding that delicate balance between them to keep the car on the road and navigate all those bumps along the way. And look, if there is just one thing you remember from all of this, let it be this. You can't just look at what the central bank is doing on its own or what the government is doing on its own. You have to look at how their actions fit together or how they clash. That interaction is what really steers the economy. And that leaves us with one last big question. As we face all these new challenges, global pandemics, broken supply chains, wars, the old economic playbook might not be enough. The debate over which drivers should really be in charge, the independent, unelected central bank, or the elected government, that debate is getting more intense than ever. And honestly, the answer is going to shape our economic road trip for years to come.